So, Wendy's stock recently shot up 15% out of nowhere, all on the rumor that Nelson Peltz's Trian fund is supposedly gearing up for a take private bid. But you really have to ask yourself, is this a genuine, massive opportunity? Or are you just about to catch a falling knife? Welcome to This Explainer. Over the next few minutes, we're going to run Wendy's through the ultimate valuation gauntlet. We're talking 21 different quantitative models. We're going to expose 14 hidden flags that the financial media is completely ignoring right now. And finally, we'll put this company through the unforgiving frameworks of legendary investors like Graham, Lynch, and Buffett. By the time we're done here, you're going to know exactly what this stock is actually worth.
Here's the wild paradox we're trying to figure out today. On one hand, you have this massive 15% stock surge driven purely by buyout speculation. But on the exact same day, if you look at the underlying reality, it is brutal. They announced a crushing 50% dividend cut alongside, frankly, terrible underlying earnings. So how on earth can a business with fundamentals this strained command such a sudden premium? Well, that is exactly what we're going to unpack.
Now, before we get into the heavy math, a quick reminder to keep us perfectly aligned with platform safety guidelines. This explainer is strictly an educational case study and quantitative analysis for informational and entertainment purposes only. It's not financial advice, it's not an investment recommendation, and it's definitely not an offer to buy or sell securities. Past performance does not guarantee future results, and all the data we're looking at is sourced from publicly available filings. As always, consult a licensed financial advisor before making any investment decisions. Okay, let's jump right in. Here's our game plan. First, the turnaround mystery. Second, running the 21 models. Third, hidden red and green flags. Fourth, the legendary investor test. And fifth, the final verdict.
Part 1. The Turnaround Mystery.
Let's set the stage here so we have an absolute baseline. As of August 14th, 2026, Wendy's is trading at $8.65 per share, sitting on a $1.6 billion market cap. I want you to keep that $8.65 price anchored in your mind. The last couple of weeks have been incredibly chaotic for the stock. On August 7th, Wendy's reported their Q2 earnings. Now, they did beat revenue slightly at $570.6 million, and EPS beat estimates by 2 cents. But then, shockingly, management completely withdrew their full year 2026 outlook. Just days later, on August 12th, shares exploded up 15%, totally fueled by reports that Trine Fund might take them private. But by August 13th, the market sobered up, speculation cooled, and shares immediately started to retreat.
And when you look under the hood, you can see why. There is a severe operational decline happening right now that these buyout rumors are completely masking. U.S. same-store sales fell 7%, and that was driven by a staggering 12.5% drop in customer traffic. People are literally just walking past the doors. Net income plunged almost 41%, down to $32.6 million. They slashed that dividend in half, from 14 cents down to 7, and they actually lost a net of 71 global locations this quarter, dropping their total to 7,180. CEO Bob Wright, who just returned in May, stated bluntly that the brand is, quote, clearly not performing at our potential. Make no mistake, this is undeniably a turnaround situation.
Part 2. Running the 21 models.
So, we threw Wendy's financials into the gauntlet to see where the true intrinsic value lies. Our cash flow models, like your standard DCF, are all clustering right around $6 to $9 a share. The dividend models, they look absolutely awful, landing between $3 and $8, mostly because the company has negative economic value added. Market multiples suggest maybe 10 to 15 bucks, but honestly, that's only if you assume Wendy's still deserves the same premium multiples as its perfectly healthy peers, or in the event of a pure buyout. Asset-based models expose a huge vulnerability. The actual book value is a tiny 61 cents per share. That means almost all of Wendy's value is tied up in intangible stuff, like brand perception. And lastly, advanced models give a $1 to $3 premium for real options, like their big plans to expand in China.
So when you average all 21 of those highly complex quantitative models together, what is the exact number we get? $6.70 per share. Remember our starting baseline? The stock is sitting at $8.65. This grand average tells us that, strictly mathematically speaking, Wendy's stock is currently overvalued by about 29%.
Part 3. Hidden red and green flags.
Let's rapidly break down what's hiding in the footnotes. First, the terrifying red flags. They have negative free cash flow conversion, meaning their working capital is literally eating cash. Even after that 50% dividend cut, their payout ratio is still an unsustainable 85%. Traffic, like we said, is down 12.5%. They're gearing up to close between 298 and 358 U.S. stores in the first half of 2026. But here's the most alarming flag by far: the value destruction. Their return on invested capital is only 5.4%, which is significantly lower than their 8% cost of capital. They are literally losing money on the capital they deploy. Throw in extreme 5x net leverage and slashed EPS guidance, and the picture looks incredibly bleak. But we have to be objective and balance the analysis, because there are 7 green flags too. The biggest one: huge insider ownership. Insiders own 9% of the company, with Tryon alone holding 8%. That is massive skin in the game. Historically, they've been great at reducing share count through buybacks, though those are paused for now. They have massive optionality with a 1,000-store China expansion planned over the next decade. They're pouring money into digital and AI to try and offset those traffic drops. You've got a new leadership team executing a 5-priority turnaround plan. The stock itself is highly defensive with a super low beta between 0.4 and 0.6. And, of course, you have that ever-present potential of a Tryon take-private premium.
Part 4. The legendary investor test.
Let's ground this dense data by asking, would the greatest investors in history buy Wendy's right now? We'll start with Benjamin Graham, the absolute father of value investing. He uses the Graham number, taking the square root of 22.5 times EPS times book value per share. For Wendy's, using their 87-cent EPS and that tiny 61-cent book value, the Graham number comes out to exactly $3.46. The current price of $8.65 is 150% above Graham's strict intrinsic value threshold. He would take one look at that weak balance sheet and pass entirely. It's not even close. What about Peter Lynch, the legend of growth at a reasonable price? He famously said a fairly priced company's PE ratio will equal its growth rate. Now, Wendy's trailing PE ratio actually looks cheap at 8, but here is the catch. Their earnings growth is a negative 34%. That pushes their PEG ratio well over 2.0. Because their earnings are collapsing rather than growing, Peter Lynch would explicitly label Wendy's a value trap. He'd pass for sure. Finally, let's run Warren Buffett's uncompromising 3-step test. Step 1, he wants ROIC consistently above 15%. Wendy's is sitting at a dismal 5.4%. Fail. Step 2, he wants low debt, ideally under 3x leverage. Wendy's is carrying extreme 5x leverage. Fail. Step 3, he demands a wide economic moat. Wendy's brand is iconic, sure, but with those massive traffic drops, their moat is actively shrinking. Fail. You know, Buffett always says it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Well, Wendy's fails on all fronts here. It is a fair company at best, and it is absolutely not at a wonderful price.
Part 5. The final verdict. To really synthesize all of this, let's quickly look at Morningstar's moat analysis. This perfectly visualizes why the business is in structural decline. Intangible assets are shrinking because the quality perception has just degraded. Switching costs? Practically zero. It costs a customer absolutely nothing to just drive across the street and eat at McDonald's or Burger King instead. The network effect is non-existent. Their cost advantage is stable, but their efficient scale is actively shrinking as they prepare to close hundreds of U.S. locations. The moat is incredibly narrow, and it is draining fast.
And that brings us to the ultimate takeaway. The current stock price is sitting high at $8.65, but the analyst consensus is much lower at $7.79. In fact, Morgan Stanley just brutally cut their target to $5.50, and JP Morgan put an outright sell rating on it with a $7 target. Then you have our own rigorous 21 model average sitting even lower at $6.70. The data proves, plain and simple, that the only real bull case right now is a highly speculative, unconfirmed take-private bid from Nelson Peltz. Everything else points to a heavily overvalued asset. So, I want to turn the final question over to you. After looking at all the hard math and running the legendary investor frameworks we just covered in this explainer, is Wendy's a classic value trap cleverly disguised as a cheap stock? Or is Bob Wright's new turnaround strategy the real deal? Drop your verdict in the comments below. I would absolutely love to hear how you interpret this data. Thanks for learning with me today, and as always, keep focusing on the fundamentals.